Hello, everyone. Clint Lee here, research analyst for the Bauman Letter, along with Ted Bauman, editor of the Bauman Letter, and we have the next edition of Your Money Matters. So, Ted, it's good to see you. How's everything going today?
It's going pretty well, Clint. Thank you. It's a little bit cooler down here in Georgia than it has been, but we're still spending most of our time working on the back garden. My wife convinced me to start laying a patio. So now that my back is recovered, I'll be working with bricks over the weekend.
Oh, don't go too hard at it, okay?
I won't.
So let's just jump right into it, because I know, Ted, you released a video here in the last week or two where you've talked about the expectation that the market's going to see a double bottom here. So what that obviously implies is that the bounce we've had so far in something like the S&P 500 index is just temporary, that we're going to roll back over, we're going to decline back and maybe see the late March lows that we had in the markets. But that goes against something else that you've stated in the past. Now, I know you've talked in the past about not fighting the Fed, and specifically all the Fed stimulus that's come out, especially over the years in terms of the various rounds of quantitative easing. You've said that liquidity is going to support asset prices. It's help drive stocks higher. But I want to call up a chart here, because this shows, in terms of that quantitative easing that the Fed has done, whenever they're doing that, they're essentially creating money and buying a security that goes on their balance sheet. This shows the Fed's balance sheet, and it shows that balance sheet just this year has increased $2 trillion. So just when you thought that the policy before was unprecedented, they go and do something like this, yet you have a different take this time on whether that's going to work or not.
Well, yeah, I mean, I think it's true that there is a dictum that says don't fight the Fed. And I think under normal circumstances, like, for example, last year, 2019, that would be true. But these are no longer normal circumstances. And I think that the critical issue here is that, yes, the Fed is pumping liquidity into markets, and a lot of that liquidity is ending up chasing stocks. And that is part of the structural arrangements in the financial sector, as we discussed last week on Your Money Matters, how it's big financial institutions who are able to receive liquidity more quickly than anybody else, and so they turn it right back into the stock market. Well, that's all true. The problem is that eventually you get to the point where prices outstrip earnings to such an extent that it's no longer rational to invest in stocks, because ultimately you invest in stocks because you're looking for future earnings, right? You're buying yourself future earnings. So the price earnings ratio is probably the single most important metric to watch. My point is that we're just now seeing the catastrophic effect on earnings of the coronavirus and what it's doing to U.S. equity or U.S. corporate earnings. And eventually we're going to get to the point where if the stock market keeps going up, people are going to say, hang on, these PE ratios are insanely elevated. It's time to back off and maybe move into treasuries. So to illustrate that, I want to show two charts. The first one shows the relationship between the S&P 500 index and its PE ratio. Now, as you can see, since the beginning of the crisis, the PE ratio has gradually outstripped the index itself, which tells us that basically people are willing to pay higher and higher prices, I think, for a given amount of earnings. Now, look back, the second chart shows you what happened in the financial crisis, and we see also that increasing divergence. But eventually it begins to tail back, and eventually both the overall index and the PE ratios start dropping down. Now, the critical thing is that right now we are at PE levels of around 20 for the S&P 500. During the financial crisis, we got down to around 9, 10. So, if things were to go like they did back then, we still have a long way to fall in PE ratios, which means that we also have a long way to fall potentially in the stock market. And the critical thing here, I think, is that it's all about earnings. This is not a financial crisis, right? It's not a deleveraging crisis. It is a crisis that is based on a decline in earnings because of a drop in economic activity. So logically, we have to see earnings fall, and therefore eventually people are going to think prices have overshot, regardless of Fed stimulus. It's time to dial back. Now, the second thing I want to show is a chart that shows the relationship between corporate equities to GDP. Now, you can see in this chart that historically, whenever it reaches an outrageous peak, like in 1999 and 2007, it corrects. Now, we are rapidly approaching 1999 territory, or we were before this latest crisis. So the long-term mean shows that we have, the potential for a big pullback. And again, I think earnings will be the trigger for that. So I stand by what I said. I think, that eventually, because this is an earnings-based crisis, eventually rational investors have to tell themselves that prices have got too far ahead of earnings.
Yeah, and I've seen sort of the same thing in the metrics that I'm tracking. So, where you're looking at the types of things that are going to drive us back to new lows from a fundamental standpoint. When I look at market internals, when I look at technical analysis, one of the things I pay close attention to is advanced decline stats. I'm looking at stock market breadth, meaning something like the S&P 500 is putting in a good advance here. I want to look underneath the hood at how many stocks are actually participating in that advance. And something I know we've shown you in the past, I'll pull up again this chart of the advanced decline ratio. This is just a ratio of advancing stocks divided by declining stocks. So a higher ratio, a higher number means there's more advancing stocks on any given day. And what I would say during this rally is that while we've seen good participation, we haven't seen great participation. We haven't seen this ratio jump up to the types of levels that we saw when it's marked prior, the end of prior downturns, like in late 2018. So this is something that would also, support at this time that we would roll back over to those lows.
So then, what, in your opinion, Clint, what's driving this recent bump? I mean, what are the key factors that are driving this? Because there's no denying that we are seeing an acceleration in stock prices. We're recording this on Friday. We're seeing that happening again today. What's driving it?
I think it comes back to this being more of a headline-driven market as opposed to a fundamentally driven market. You look at the headlines, as you mentioned, this is Friday as we record this. Just overnight, we've seen announcements from President Trump, from state governors are working on different phases of reopening the economy. We've seen positive headlines on the drug development front, therapies to combat the coronavirus. Gilead in particular has demonstrated success with an antiviral treatment. But this does not change the fact that we've seen 22 million people now over the last 3 or 4 weeks file for unemployment benefits. So as you stated before, the fundamental outlook is still pretty dire. And then I think the last thing that comes into play really comes down to short covering, especially in certain sectors. So anyone that's been shorting securities to where you profit from the decline in this market, it's natural to want to lock in those gains from time to time. For someone that's shorting a security, to do so, you have to step in to buy it. And I think that resulting buying pressure, especially in groups like energy stocks and airlines, has been a big factor behind the bump we've seen in this market up to this point at least. But at some point, we will find a bottom, whether it's just retesting those late March lows or heading down even further from there. At some point, the bottom will come into play. I'm used to that bottom being driven in the past by Fed events, whether it's the Fed announcing more QE or announcing that they're going to start to lower rates instead of tightening rates. What's it going to be this time, Ted, that it finally marks the bottom? What's going to be that catalyst this time around?
Well, I mean, I think, first of all, just to be clear, when we talk about a bottom, you're right that this is a headline-driven market. And, I'm open to the possibility that there may be a radical headline that comes along that, in a sense, says that we have reached the light at the end of the tunnel. And maybe at that point, then we can say, all right, we're not going to go back to those lows. But, that seems highly unlikely. I think you're right. If the market is anticipating, it's kind of wishful thinking at this point, hoping that something's going to happen. Now, if that doesn't, here's what I think is going to happen. I said earlier that I thought that eventually the effects of the Fed liquidity is going to run up against the reality of earnings declines. And obviously they have to decline in a broad range of industries, everything that faces the consumer, retail, you name it. In my video on Friday, I showed how sector after sector is just experiencing catastrophic rapid declines, and in retail sales and all these kinds of things. That's going to hit up eventually. Now, what happens to that liquidity? Well, when there's money looking for something to do, eventually it runs out of opportunities to score yield. We've seen Fed liquidity in the last decade going to stocks, going to junk bonds. But eventually, I think what's going to happen is it's going to just want to sit and be safe. And that means that we're probably going to see further declines in long-term yields in the Treasury market. Now, I want to show you a chart that shows the evolution of basically the price of a 10-year Treasury bill. And as you can see, it is near, well, it really is at its all-time lows. I mean, for realistic purposes. We could see negative interest rates in Treasury markets. We could see people saying, we've run out of patience with risky yields, and people start piling into Treasuries. Now, that is not the Fed doing this. It's not Fed setting interest rates negative. It's basically buyers in the market saying we would rather have Treasuries than anything else at this point because at least we minimize our risk. So that could happen. And if it does happen, I think that in itself would be a headline that would scare a lot of investors. So remember, liquidity just means that there's money available to buy assets. The relative attraction of those assets depends on all kinds of things. But at the end of the day, it all depends on what you can actually expect to earn by buying those assets in the long term. And that's where we're stuck right now.
I know negative yields certainly wouldn't be unprecedented. At least in other parts of the world, we've seen trillions of dollars in debt, especially government securities, in negative territory. But with someone sitting on a portfolio, especially an investor with a stock portfolio, and with what we've talked about here, if we do see another decline, what should somebody be doing at this point, or what should they be thinking about at this point with their portfolio? What's the strategy they should be using here going forward?
Well, I mean, absolutely, there is opportunity to buy and to set yourself up for long-term profit. And I want to show a chart that shows, the effect of a strategy like that that I found on the internet earlier today. And it shows what happens if you were to invest in stocks just after a big decline versus whether you were to have just bought and hold. And clearly, buying when stocks are at a low does lead to longer-term better performance than simply waiting it out and buying only when a rebound starts. But that doesn't mean that you have to try to time the market. I think the key thing is dollar cost averaging. And again, this is something I mentioned on Friday. People should be buying in increments as stocks decline on a down day. I mean, even during these recent spikes, we've seen stocks that will go up by 5 or 10% on one day and then 5 or 10% down the next. Well, buy them on the down day as long as they have long-term potential and they're going to rebound. And we've said before, look at their balance sheets, look at the nature of their business, look at what they're exposed to, all that kind of thing. So when you've picked your stocks, don't be afraid to buy them, but just buy them when they're at a discount. And I think at some point, people are going to find that doing that is going to create really average prices, a cost basis for their position as a whole, which is going to lead to tremendous gains as the economy does recover eventually. And I've mentioned housing in this regard. A lot of people have kind of ridiculed me for saying that investing in housing stocks is a good bet. It's just that they're so cheap. So, people need houses. That they're going to need houses when this is all over. Maybe not at the end of this year, maybe halfway through next year. But if you buy a stock that's trading at a PE ratio of 3 or 4 right now in the housing sector, the big construction companies that normally trades at 20, just do the maths. I mean, you buy it now, you let that money sit until things recover, you're going to be, sitting on tremendous triple-digit gains. And that's what it's all about. It's, don't think short-term in this situation. Protect yourself, invest wisely, grab stocks on the way down. They will recover. But we may have further to go before this is all over. So focus on being a bargain hunter. I think that's what it's all about. Don't get obsessed with the bull market. You only invest in individual stocks, and that's what you should be focusing on.
I think you bring up a good point that a lot of investors lose sight of. And I think a lot of times we obsess over wanting to pick the right stocks or be in the right sector. But a lot of times you lose sight of having a portfolio management strategy. Things like allocating properly, things like what you brought up with averaging down on your costs when you have the opportunity to do so. Because that's something we talk about frequently in the Bauman letter. In addition to our recommendations in our newsletters and our video updates, our various portfolio updates, we spend a lot of time, I know you and I do, talking about portfolio strategy there as well. So if you're not a subscriber to the Bauman letter, to get started, simply follow the link below this video. And that's going to do it for us today. This is Clint Lee and Ted Bauman for this edition of Your Money Matters. Thanks for joining us.